Ali, let's talk about how much of today's surge is warranted.
It's mainly because that these guys are actually progressing towards that profitability, which we think can take place in about 3 to 4 years. And I'm talking about on a gap, from a gap standpoint. But really what impressed us yesterday or last night was the fact that that network effect is actually working for these guys. You're seeing more riders. You're seeing each rider actually take more trips. So that demand is still there. And on the driver's side, or what we refer to as the supply side, the drivers continue to stay with Uber. The cost of acquisition on the driver's side is also declining. So there's a lot of operating leverage that they're progressing towards, which we think actually makes the profitability more likely a few years down the road.
Is this what we expect out of a company that's going to lose $1 billion this year?
Look, I think the stock reaction today reflects the fact that investors feel like visibility is improving a bit. We finally have now a precise quarter that we can look forward to as far as EBITDA profitability. That target, though, it makes some assumptions. For example, management remarked last night that it assumes that the competitive environment, competitive intensity actually moderates a bit further from kind of the tame environment today. So we need to see a little bit more moderation on that front. It's unclear what it bakes in terms of regulatory impact. So, I don't think it's a slam dunk that they hit this fourth quarter target. But I think what's really going to be interesting is if they sort of see adverse development on the competitive side or the regulatory side, how does management react? How do they approach those trade-offs between growth and profitability? Do they want to hit the profitability target and growth suffers as a result? And how does the stock react to that?
Ali, I'm looking at your notes from today. I mean, you talk about a moat for Uber. How confident are you that this is a company that can reach profitability, at least on an adjusted basis, by the fourth quarter of this year?
Pretty confident. Again, as Tom mentioned, there are already indications. Let's put it this way. The rides part of the business is already profitable. The adjusted EBITDA margin actually expanded to 24% in Q4. And they actually cover a lot of overhead costs already within the firm. So we think that's positive. What we're waiting for, what we're trying to see is basically whether that network effect that's applicable to the rides business is also going to be applicable to the Eats business. And we're seeing some signs of that. There is some stability in the take rate that they have. And we're thinking that probably near the end of this year, we will see actually some stabilization in pricing for Uber Eats. And we think that's going to help them progress more towards profitability. So to answer your question, we are pretty confident that these guys can actually hit their guidance at the end of the year.
Tom, tell me about consequences, though. For a long time, a lot of cash was subsidizing these pricing actions, these low prices from Uber, from Lyft, et cetera, from DoorDash, from, go on and on and on. It seems like some of that cash is backing away. Look at what's happened to SoftBank, et cetera. Now investors want to see at least a path to profitability from all these companies. Does that mean growth is going to slow down, and have they talked enough about the impact on the top line over the next couple of years?
So far, growth seemingly hasn't really been all that impacted from either pullback of incentives or couponing or other things that are raising prices for consumers, like surcharges being levied on ride sharing by cities like Chicago and New York and others. So far, we haven't really seen much impact. At some point, you would have to imagine that it starts to erode sort of the number of use cases or the ridership if fares kind of keep going up. But I think what Uber's been able to do, and probably Lyft as well, is they've been very surgical about how they're passing through price increases. So kind of the least sensitive riders are getting price increases, and the least sensitive markets are, and other more sensitive markets are maybe just getting sort of minor price increases. So you haven't really seen an impact on growth yet.
Maybe fewer 30% discounts, you'd say.
Probably.
On margin.